Hello and welcome. Today we are examining specific coupon payment structure that differ from the standard fixed rate model. We will focus on zero coupon bonds and deferred coupon bonds. These instruments manage cash flows and risk in a unique way. So let's get started with the defining first zero coupon bonds, which we have previously also discussed, but let's reiterate this. Let's begin with the zero coupon bond, often called a pure discount bond. Unlike standard bonds that send you a check every 6 months, this bond pays no periodic interest at all. Instead, you buy it for a price significantly lower than its face value. For example, you might buy a bond for $800 today, and in 10 years, the issuer pays you $1,000. Your profit or implied interest is that the $200 difference realized at the end. So, a zero coupon bond generates returns solely through price appreciation from a discount, not through a periodic cash flows. So this is same shown in the diagram as well. Now reinvestment risk examinations with the a major advantage of the zero coupon bond is the elimination of the reinvestment risk. With a regular coupon bond, you have to find a place to invest those interest checks, and interest rates might drop in the future. Because a zero coupon bond has no entering cash flows to reinvest, you lock in your total return the moment you buy it, assuming you hold it to maturity. This makes them excellent tools for funding specific future goals like college tuitions or pension liabilities where you need a guaranteed sum on a specific date. Zero coupon bonds offer certainty of future value by removing the variable of reinvesting coupons. So similar comparison is shown in the diagram which highlights the risk difference. So there are two parts shown: a coupon bond facing reinvestment risk. If you are having a coupon bond, then it has a reinvestment. Coupon must be reinvested. If you go for zero coupon bond, reinvestment risk is not there because return is locked until the maturity. So now discuss about the deferred coupon bonds. Now let's look at the deferred coupon bonds, sometimes called split coupon bonds. These are a hybrid structure. For the first few years, perhaps 3 to 5, the bond pays no interest. After this deferred period ends, the bond begins paying the coupons, usually at a rate higher than the market rate to compensate for the initial wait. This structure is very useful for issuers who need to conserve cash immediately, perhaps to build a factory but expect to have a cash flow later to pay the higher interest. Deferred bonds delay income to the investor to help the issuer manage early stage cash constraint. Sorry. These timelines which you see in the diagram, the cash flow of a deferred bond. The first section labeled with a no payment. So it starts with 2023 until 2026 you don't get any payment. Your first payment comes into 2027. This is a deferred period. This period is called the deferred period. The second section where high coupon payments, you would get a high coupon payments, begins in 2026 and continues to the end. The final diamond represents the return of the principal, so you would get your principal back at here in 2030. This clearly shows the split nature of the income stream. Now let's talk about the PIK bonds, payment in kind bonds. A variation of the deferred structure is the payment in kind or PIK bond. With a PIK bond, the issuer has the option to pay interest not in cash but by issuing more bonds or securities. Essentially, they are paying you with more debt. This allows the issuer to save cash for operations or capital expenditures. However, these are typically considered riskier and are often issued by companies with lower credit ratings. For the investor, your principal balance grows, but you do not see cash until the bond is sold or mature. What is the takeaway here? PIK bonds prioritize issuer liquidity by substituting additional debt for the cash interest payments. So if you see in this diagram, the decision process at the interest due. When the interest is due, a standard bond moves to cash payment. If there's a standard bond, it would pay you the cash or your interest back. However, the PIK bond would issue the additional bonds to you. This leads to increased principal, which then loops back to the next interest due cycle, like this. Correct? Which then loops back to the next interest due cycle And that loop visualizes how the debt burden grows over time without cash changing in the hands. Now let's go to the OID, the tax consideration. A critical aspect of this structure is taxation. Even though zero coupon and deferred bonds do not pay cash immediately, tax authorities often treat the increase in the bond value as taxable income each year. This is called the original issue discount or OID tax. It creates phantom income, meaning you must pay tax on money you have not physically received yet. Because of this, these bonds are often best suited for tax deferred accounts like pension funds or IRAs. You may face a cash tax liability annually even if the bond yields no cash until maturity. Similarly, on the flow chart, how the phantom income trap works is shown. We start with the bond accrues value. We ask cash received. Whether have you received the cash in this case? And the answer is no in this scenario. Despite this, the path leads to a taxable income. You have to pay the income tax, generated income. The final red box highlights the phantom income effect, emphasizing the disconnect between cash flow and tax liability. So that is what you need to remember. What is the phantom income effect? Which emphasizes the disconnect between cash flow and the tax liability. Now let's move and touch on the duration and price volatility. We must also consider risk. The Macquarie duration of a zero coupon bond is exactly equal to its time to maturity because they lack early cash flows to offset price moves. Zero coupon bonds have the highest duration and price volatility for a given maturity. If rates rise, the price of a zero coupon bond will fall more dramatically than a standard coupon bond of the same length. This makes them powerful tools for speculations but risky for perseveration if you might need to sell early. Zero coupon bond carry maximum interest rate risk per year of maturity compared to the two coupon bonds. So to trigger the event, as you can see in the workflow, if interest rate rises, this impacts both bond types. The top path, the coupon bond, which is your coupon bond, which continuously pay coupon to you on some defined frequency, price falls moderately. But in case of zero coupon bond, price falls very sharply, which highlighted box emphasizes the higher volatility risk associated with zero coupon bond. Now, issuer motivation. Why issuer want to invest? Why do issuers sell these bonds? Why issuer would sell these bonds? Primarily for cash flows management. A company building a new no new toll road or factory might not have revenue for years. By issuing deferred or zero coupon bonds, they avoid paying cash interest during the construction phase. Additionally, in many jurisdictions, the issuer can still deduct the accrued interest as an expense for tax purposes each year, even though they have not paid out cash yet. This provides a tax shield. This structure allows issuer to match their debt payment with their expected future income stream. So let's look at the map chart here. What is the issuer's logic here? The issuer needs capital but asks cash available or not. Issuer needs a cash but cash is available or not. If no, they issue a zero coupon bond or a deferred bond, which leads to benefit, no cash outflow and a tax reduction claimed. Both branches converge on invest in a project, showing how the structure supports long-term growth without immediate liquidity strain. Let's summarize this. To wrap up, we have covered the unique landscape of non-standard coupon bonds, which is zero coupon bonds, offer locked-in returns and eliminate reinvestment risk, but come with a high volatility. Deferred and PIK bonds offer flexibility to issuers facing cash constraint but present credit and complexity risk to the investors. Finally, we noted that the tax rules like OID can create tax bills without cash flows. Understanding these structures allows you to better match specific liabilities and risk tolerance for your CFA exam, which summarized in this maps on a non-standard bonds. It branches into three main types which we discussed: zero coupon bonds first, then deferred one, then PIK1. It connects zero to no reinvestment risk. Means if you are having a zero coupon bond, there is no reinvestment risk and high volatility. But it has a high volatility. It links deferred to cash conservations and PIK to pay it with the debt. Finally, it connects all of them to a tax implications of phantom income, providing a complete overview of the modules. So that's all today. Thanks for watching. I'm stopping now.